2015 Second Quarter in Review webinar. I'm Sheldon McFarland, Vice President of Portfolio Strategy and Research at Loring Ward, and will be your host for today's webinar. As usual, with me is our presenter, Matt Carvalho, Director of Research here at Loring Ward. This webinar is provided by LWI Financial, Inc., Loring Ward, an investment advisor registered with the Securities and Exchange Commission. Securities offered through Loring Ward Securities, Inc., member FINRA SIPC. Our presentation today will last approximately 30 minutes, followed by a 10-minute question and answer session. To ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Please feel free to ask questions at any time during the presentation. Your questions will not be viewable by other attendees and will be addressed during the Q&A session at the end of the webinar. All participants will be in a listen-only mode for the duration of the webinar. I ask that you keep all questions general in nature and refrain from submitting questions pertaining to your specific situation or portfolio, as we cannot address them on this webinar. It was relatively quiet last quarter in terms of performance and headlines, although we saw a pickup in news towards the end of the quarter.
Well, thank you, Sheldon. I'll pick it up from there. And as usual, we'll start off with a look at many of the headlines and try and figure out what their impacts might have been to investors. So let's start off with one familiar headline, which has really been the ongoing drama in Greece. So when we looked back at the news stories, I actually found one tweet in particular that I thought did a good job summing up the weekly news from Greece. This was from a Bloomberg journalist, and he just mentioned Grexit, no Grexit, Grexit, no Grexit, and so on, really showing that day to day there was so much uncertainty about what was going to happen with the rescue plan, or perhaps Greece leaving the euro, going back and forth, that really at the end of the day it was almost a coin toss. But how did we really get to that point? Well, it's been ongoing for quite some time now. So starting in December 2009, Greek debt was finally first downgraded, with fears that they might eventually default on that. They later received the rescue package in May of 2010. Many debt holders took a significant haircut of about 50%, or took a 50% loss on Greek debt later on in 2011, and so on, getting us to the point where we are now in mid-2015. Now, thinking back, this has actually been a pretty long time span. Back in December 2009, the biggest movie actually in the box office was Avatar, which seems pretty old to me now.
I have a son that was born in 2010, and thinking about this, how long it's been going on, I wonder if he or his generation, will they know a world without Greek debt issues, Matt?
Yeah, that's tough to say. How bad is it really in Greece? Well, I wanted to plot the unemployment rates. And I first started off with just the U.S. numbers here, and we know unemployment felt pretty bad a couple of years ago here in the U.S. when it approached 10% in 2009. And, Greece was right along the same kind of trajectory as we were at that time, but since the financial crisis we faced here in 2008, Greece has really worsened in terms of their unemployment rate, and they now sit at about 25% of the population being unable to find jobs. When you actually look at Greece youth, you actually find a pretty frightening number at about 50% unemployment rate there. So that's pretty tough for a country to overcome, and it certainly had a very big impact on their GDP. So on the right side of the table here, what we're showing is the impact to the Greece economy over the years from 2008 through this year, and we're just comparing that to the experience we had here in the U.S. during the Great Depression. And both times were pretty similar in that the economy shrank by about 25%, which is an extremely painful event. And, luckily for us here in the U.S., we did actually rebound pretty quickly in the mid-30s. And hopefully Greece can do the same, but it's really unknown, exactly what the future will hold. So this situation is obviously very serious, but is it very rare? Well, when we looked back, we found some materials looking at the share of years in default or rescheduling. So this is basically the percentage of time that a country historically since 1800 has been in fiscal trouble. They've either defaulted on their debt, or they've been having to reschedule or somehow restructure their debt. So here in the U.S., we think of our U.S. Treasury bills and bonds, notes that we've never defaulted on. So you see the U.S. over here at 0%. But we see Greece historically has actually had about a 51% default rate, meaning that half of the time since 1800 through the end of 2008, they've been in some type of circumstance as they are in right now. Now, when we look at some of the other countries on the list, some of these are pretty familiar names in terms of having debt troubles, such as Argentina, Mexico, or Russia. But one thing a lot of those countries were able to do is have a lot more flexibility with their currency, being able to depreciate it so that they could try and become more competitive in the global economy.
So would Greece be better off just leaving the euro?
Well, that's certainly a thought that many people have had. By leaving the euro, they could go to basically a cheaper currency, perhaps going back to the Greek drachma. But there are some downsides to trying to do that. So think about a couple things just in terms of logistics. Something so simple as those bank ATMs. We've all seen the images of everybody queuing up to take out their 60 euros a day. All those would have to be manually changed to now, contain and accept and distribute new forms of currency. Things like toll booths down here on the left, or even just a simple vending machine that was set up to accept euro coins is now going to have to be changed. And estimates are that could take about 6 months to 2 years to actually physically go through and change everything in an economy to a different currency system. There's also the inflationary pressure. So when you devalue your currency, everything that you're importing suddenly becomes far more expensive. So for the average Greek citizen, if they were buying food from France, if they were enjoying their Netflix subscription or planning to buy a German car, those things now become 50, 100% or so more expensive overnight, simply because the currency that they now own, instead of being euros, is now worth far less. So what does that actually mean for investors, for all of our portfolios here? Well, I wanted to try and put things in perspective here, and we're going to look at the world market capitalization. So this is the total value of all the stocks out there in the world, all the publicly traded companies. And if we look at a percentage of that, we see the U.S. is roughly half. So definitely the largest single market in the world, basically half of the stock market valuation. When we look at Europe, we see that's about a fourth, 26%, so a pretty big chunk. But then when we look at Greece in particular, we actually find that there's 0.04%, so a very tiny fraction of the overall market. When you compare it just to a simple household name like Starbucks, you see that it's less than a fourth of the size of that single company. So I think the worry with Greece has always been beyond just the Greek market, though. It was really unknown if one troubled company was to leave the euro, would Italy, Spain, or Portugal follow that path? In previous Greek scares, we saw bond yields rise significantly in those other countries. But this time they've actually stayed very low, which has been a very encouraging sign, seeing that there's some kind of decoupling between the path that Greece takes and the other countries that had faced some fiscal troubles. And I think the environment was pretty well summed up recently by Treasury Secretary Jack Lew, and he said that the risk is very different than it was in 2010 and 2012. The risk of contagion has been contained. So certainly we don't know exactly what would happen if Greece was to leave the euro. There would certainly be a lot of unknowns around that. But I think the general consensus was that the rest of Europe and the rest of the world would be far less impacted by it than if that was to have happened 5 years ago or 3 years ago, when people had had a lot less time to prepare for it. So let's move on and go back to our Wordle here. And again, these are just all the headlines from Yahoo News during the quarter on Yahoo Finance. And so we wanted to use that as basically a path to see what was going on in the markets. And now we'll focus on another story much closer to home, but also about debt. And this one was basically breaking right at the end of the quarter. So on June 28th, Puerto Rico's governor said that their $72 billion in debts was basically unpayable, and that they were in a death spiral of debt. Now, a couple notes here on Puerto Rico is that they actually have more muni bond debt per capita than any other state. And to try and put it in perspective, their debt level is actually 8 times more than the city of Detroit. But they were a pretty interesting type of bond for many portfolio managers to add to their portfolios because they had what was called a double tax-exempt status, meaning that the interest paid on those bonds was exempt from both federal and state taxes, which is very beneficial for most investors. But we want to try and put into context the risk that you were taking on by investing in Puerto Rico bonds. So what we're showing over here is the S&P credit description. So we have everything from AAA to single C, and basically the higher, the less likely they are to default, the lower, the more likely they are. And what I'm highlighting now is actually what's called the investment grade universe. So that's everything from AAA to BBB minus. And you can see the rating description on the side: prime, high grade, medium grade. Basically all these are companies or countries, territories that are very unlikely to default in the foreseeable future and are thus kind of grouped into this term called investment grade securities. Well, when we look around the U.S. and we look at some other states that are often in news for being in fiscal trouble, I often think about California here where we are, or Illinois we also hear a lot about, but both of those are still rated fairly highly in the overall spectrum of credit ratings. And what really sticks out about Puerto Rico is that it was all the way down here at CCC minus. So it obviously had a very high yield, but there was certainly a lot of risk involved. The credit rating agencies are saying there are substantial risks with Puerto Rico being able to pay back these bonds on schedule.
This is a great example of risk and return being related. Here we have Puerto Rico that was much riskier bond, but paying higher yields. And now we're seeing that risk is being collected in the form of lower bond prices.
All right, so let's move on now, and we'll go to the Wordle one more time. And this time we'll talk a little bit about China. So China's certainly been in the news quite a bit lately. And just a couple brief updates here. Obviously we know China, GDP-wise, gross domestic product-wise, is now the second largest economy in the world. And it's actually the largest trading partner with the rest of the world. And investors, we often have heard stories about McDonald's or KFC, other companies, expanding into China because it is a huge market economically and also population-wise. But why are we just now hearing a lot in the news about the stock market there? Well, I'm showing right here just kind of a piece of that was actually, if you look at Google Trends, you can find how often the term China stock was searched for, and we see a dramatic spike just within the last month or so. So what's really been going on there? Well, before we get into the actual numbers of the exchange there, I want to really just take a second here with this table and try and differentiate some things that you might hear in the news. So a lot of the recent news stories are regarding the China A-shares market. Now they have two different markets, basically an A-shares and an H-shares. Now the A-shares are traded in Shanghai and Shenzhen. It's a very large market, but there are significant capital flow restrictions. So for example, if you were to buy a company, make an investment there, sell it at some point down the road, you might have restrictions in actually bringing your capital back out of those markets, back into the U.S. or wherever you reside. But there are also limited selling options, and in fact about 90% of the market is currently suspended from trading. So this is a very highly regulated market. It's also pretty new to foreign investors, so there are still many restrictions in place about how much you can invest there, about the flow of capital in and out. And you contrast that with the H-shares market, which is still Chinese companies, but these are ones that have been listed in Hong Kong and trade in Hong Kong dollars and have been available to foreign investors for a much longer time period. So I do just want to make this distinction because I think, for most of us here in the U.S., when we think about a stock trading, it really doesn't matter if it's trading on the NASDAQ or on the NYSE or any other market. They all pretty much behave the same way in terms of we can access our flows, we can sell it whenever we want, we can withdraw that money whenever we want. They have similar types of settlements, but it's much different when we're actually talking about Chinese stocks.
So given that most of these headlines that we're seeing are focused on the A shares, how should we as investors react when we're seeing these headlines?
Well, what's important to note here is this very bottom line. And so historically there's been very little coverage or exposure into the A-shares market because it has been very limited over time to foreign investors. And so even most international benchmarks will include a China exposure, but in almost all cases it's what would be the H-shares exposure. So those companies listed in Hong Kong that are much more accessible to foreign investors than those in the A-shares market. But most of the headlines recently have been regarding the A-shares market, as it's really had quite a lot of volatility. So what I'm showing with these two stars here is actually over the last year, that market is up over 100%. But what we've been seeing in the news lately is really relating to the last month or so. In June, it fell by a pretty significant amount, about 20 to 30% at one period. And then just over the couple days this week, it's down about another 10% or so. So it's a very quickly moving market, and there's also a lot of government regulation trying to, in essence, prop up those stock prices. But what I did want to take a look at is a much longer term perspective here. And when we look over the last 10 years, we can see that, at this recent part here, even if the market's fallen by, a more significant amount now, is still, basically as we should expect historically in a market like this. So this blue line is the MSCI China A-shares market return since 10 years ago, since June of 2005. And we can see some periods where it's had dramatic rises, similar to what it's had the last year or two here, and then some pretty significant falls as well. Meanwhile, we see the H-shares market tends to be a little bit less volatile, but still pretty significant moves here. And then we've also put in the S&P 500 return, just to show as a contrast that 2008 felt pretty severe to us here, but yet that was really a pretty tame move in terms of comparison to these other markets. So I think our takeaway here is just to remember that emerging markets have a very well-deserved reputation for volatility. So this is why you wouldn't want to have significant portions of a portfolio into those, because it's going to be awfully tough to sleep at night when you are going to see gains or losses at that magnitude. So with that, we'll move on and talk just about the most recent quarter here, what really happened in some of the broad asset classes around the world. Well, we ranked these asset classes from best returner to worst for the second quarter of 2015, and we see that international small cap had gained over 4% as the leader there. Emerging markets value did pretty well as well, gaining nearly 2%. And then we see a lot of asset classes were fairly flat for the quarter. U.S. small cap, U.S. large, most of these were, just barely positive for the quarter, and we see things like cash being flat. But the one kind of outlier here was U.S. REITs, real estate investment trusts. So these can be a little bit more susceptible to interest rate moves, and interest rates did rise by some degree during the second quarter. And so a lot of expectations moved pretty quickly on those, and we saw a pretty significant move with REITs going down 10% for the quarter. But when we put that into perspective over the last 15 years here, and again, we've just ranked each asset class according to the highest performer at the top here to the lowest performer, we see REITs actually drastically outperformed the rest of the market in 2014, gaining over 32%. And then we're now showing the year-to-date numbers here where REITs are down nearly 6% for the year. But again, compared to most other asset classes, really, if you'd followed only what did the best last year, you're probably never going to have the best performer the following year. Now, what we also have highlighted here in the middle is just the idea of a diversified portfolio. In this case, we're highlighting a 65% exposure to stocks in these different indexes and a 35% exposure to bonds, that's always going to keep you towards the middle of the pack, which has some benefits because either during accumulation when you're able to rebalance and grow a portfolio over time, or if you're in a distribution phase, if you're in retirement and withdrawing from the portfolio, the ability to avoid some of these years where you're the absolute worst performer and some of these very significant losses down here is going to do a lot more good to your portfolio than trying to guess each year what the best performer might have been. So one point I wanted to mention here is just, we've seen some more volatility lately where stock prices have fallen by a couple percent, but I did want to highlight even in this great bull market that we think of, stocks being up almost on a straight line since early 2009, we have seen many pullbacks of pretty significant numbers here. So if we can remember back to 2010 or 2011, there were periods where the market had fallen 10, 15, almost 20% from what was the previous all-time market high, and then had went on to rebound. So it is something that we should expect, that we're not going to continually be at an all-time high every single day.
So we're going to do something new today. We're using a live polling system. So a question will be presented to you. You're going to have roughly 25 seconds to answer that question. You can click on the radio button to select your answer. We're going to compile those answers real time and then work that into our presentation.
All right, so here's our poll question. And we really just wanted to ask, we have a great audience on the line here, and we wanted to get a sense. So which market do you believe will be the best performer over the coming 12 months? So we have a couple options on here. We have something like U.S. stocks, which have really been the best performer over the last 5 years or so. We have Greece stocks, perhaps nowhere to go but up. China stocks, perhaps thinking the government will restore confidence there or continue their performance over the last year. Or U.S. bonds, really, if you're worried about the stock market in general, you might think that that could be the best performing asset class. So we'll give just a couple more seconds there, and then we'll show the results here. All right, so there are our real-time results, and looks like a little over half of the audience selected U.S. stocks. So really the idea that, we've been the best performing asset class for the last couple of years now. Unemployment in the U.S. has been falling. Inflation is really very benign. And the dollar has been pretty strong lately. So it's, perfectly reasonable, I think, for an investor to expect that. But I think it actually does, play pretty well into an analogy that we were thinking of. And we'll go to our next slide here, in which we want to discuss the idea of just what's involved with investing. So I wanted to use the analogy of a show called The Shark Tank. And I think most people have seen an episode or two of this over time. Basically, it's pretty simply the idea of there's this panel of investors with capital, so these 5 people that you're seeing on the screen here. And every week on the show, they hear pitches from companies looking for funding. So then they're able to negotiate terms to be acceptable to both parties. So they're going to offer more money for opportunities with greater potential, or less money or less generous terms to those companies with less certain futures. Now I want you to imagine if you were sitting on this panel and you saw a representative come in from Greece, and let's say they had a Greek yogurt company. Now they are going to come in and say, well, we're looking for funding for our company. We think we have a great product, but the unemployment rate is pretty high in Greece. The economy's been shrinking, and our currency outlook is pretty shaky. We might be converting currencies at some point in the future. Well, then you have to contrast that with, let's say, somebody coming in from a German car maker, and they're going to say, we have a very stable forecast for our sales. We have a very reliable consumer base. Our political and economic system is pretty stable. So we just need this money to, fulfill some more orders that we already have. Well, thinking about that, you're going to offer much different terms to those 2 different companies. And in fact, that's what happens in the stock market, is that prices are going to adjust to the point where the investor is being compensated for the risk that they're taking. So if they're both offering, say, 10% of their company to you, well, the Greek yogurt company is going to receive a lot less than the German car manufacturer. And that's basically what we've seen in the markets, as prices in Greece have declined quite substantially, as investors are really pricing in that additional risk that they're taking for companies in Greece.
If you think about the sharks, they're taking their money and they're investing in, 10, 20, hundreds of companies. They're getting the benefits of diversification there to help reduce the risk. By pulling assets into asset class funds, investors can get that same type of leverage. They're spreading their assets across many companies all around the world. And they're getting exposure that they wouldn't be able to get by directly investing in those companies, because most people just don't have the assets to get that type of diversification.
All right, so I think our takeaway here is just, knowing that not every company is going to pan out, right? But that's the reason why you want to own thousands of them around the globe. So now we want to shift just to one final poll question here. And again, we are aiming to make these more interactive over time. And you'll notice this is pretty similar to the one we just asked. We did want to word it a little bit differently. So here we're saying, based on the risk involved, which market would you demand the highest rate of return from? So we'll give you a couple moments here again to vote. And again, we have those same answers: U.S. stocks, Greek stocks, China, and also U.S. bonds. Okay, I think we can wrap it up here and get some pretty interesting numbers. Look at that, quite a large number now, almost 3/4 of the audience going into Greece stocks. So this is a pretty great result, and really what we were hoping to accomplish here is just to try and kind of shift the idea that a lot of times, it feels a lot safer to invest in, a domestic market or a market that we're far more familiar with. But at the end of the day, we just have to realize that if you want to capture those market returns around the globe, you have to realize that there's going to be different risks out there, and you need to stay invested in those different markets, rebalance over time in order to capture those higher expected returns than you would expect from something safer like U.S. bonds. And I think we always just need to remember that investing is a trade-off, so we can avoid markets like Greece or China or any stock at all, but you'd have to give up those higher potential gains that come along with that risk. And for most investors, that can make it pretty tough to meet our long-term financial goals. So by working with a financial advisor, you can really find that right balance for your own portfolio to meet those goals.
Great. Well, thank you, Matt, for another very informative presentation. So I'd like to open it up now for a Q&A session. Again, to ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Your questions will not be viewable by other attendees. First question that we have here that's come in: with many markets basically flat over the last year, shouldn't I be worried? Well, I went back actually recently, was working on a similar topic to that and looking at data for the S&P 500, the U.S. market, basically benchmark. Back to 1926, there were roughly 9 years where the market was relatively flat, meaning within plus or minus 1.5% return for the first 6 months. Looking at those, 6 out of the 9 had positive returns for the second half of the year and ended up positive for the year. So just because the market is flat the first half of the year, that's no indication that the next half of the year that performance is going to be flat or that the market's going to be negative. We have to be careful that we're not letting performance dictate our portfolios and how we manage or how we invest those portfolios. Remember that your portfolio should be set up to meet a specific goal, whether that be retirement, whether that be traveling, whether that be college education funding for children, grandchildren. That should be the focus of the portfolio, and it should be invested to meet those goals, not based on reacting to performance. Another question here. that's come in. So I recently saw a fund manager comment that stocks are more richly priced than ever in history if you factor worldwide QE. What is your thought about QE and its impact going forward?
Well, I think that's a tough one to ever really, be able to know its direct impact, because we've never seen anything exactly like it. But I think there's also just the idea that, nobody's expecting that to continue on forever. People are expecting rates to rise at some point, and so if they know that's coming down the road, then that's going to be basically already part of the price of different securities. So I think it's important to just remember that there's not non-public information out there about what exactly rates are going to do, and that when the Fed finally does raise rates at whatever point, it's going to come as a shock to people. I think you could certainly see more volatility during times like that as everyone kind of figures out how it's going to impact everything. But I think people have been worried about that for the last 3, 4, 5 years now. And if you've sat on the sidelines and not participated in the equity markets, since 2010 or whenever people first started worrying about that, you've missed out on some phenomenal gains during that time. And I think it's a very risky game to try and time that.
And if we think about the Fed and if we think about these governments, what they're doing with quantitative easing, is they're trying to prop up, or they're trying to spurn demand within the economy by lowering rates, etc. If we think about what would happen if they started to pull that back, or why they would pull that back, it's important to remember if they started to pull back that QE, it's because the economy is starting to heat up and things are doing really well. So I think that a lot of the naysayers out there would say, well, once these governments pull back, everything's just going to decline. But you have to remember, they're not going to pull back until we start to see those economies heating up. And when that does, that means it's going to be a good thing for the stock market. But on top of that, the most important thing to remember is the overall trend in the market over the long term has been up. If you're a long-term investor, you really don't have to worry about those types of things, because yes, the market is going to go up and down. It's going to have some bumps in the road. But if you are a long-term investor, chances are the market's going to be positive over that long term. Another question here is, given the volatility in Shanghai, how much of our portfolios are affected by that performance?
Sure. Well, and it has been interesting to see, because previously till about a year ago, anytime you'd see mentions of the China stock market in the media, it was typically about the H-shares index, which most international investors have had some small exposure to over the last 5 or 10 years. But more recently, the A-shares index has kind of gotten a lot of notoriety because it's moved so dramatically. But that's actually not included in most international indexes. So the index providers like MSCI and FTSE have started to have some news releases on that recently about the timing that they may add that to indexes at future dates, and so investors may be more likely to hold some exposure there. But as of right now, the typical investor probably doesn't have any exposure directly to the Shanghai index, and their exposure to something like the Hong Kong exchange, the H-shares that we mentioned, might be 15 to 20% of an emerging markets exposure. So if an investor had, say, a 5% allocation to emerging markets, that might equate to only about 1% or so of their portfolio being directly into China stocks.
With the outlook, what is the outlook for bonds with the Fed proposing interest rate increases?
Sure. Well, so I think with bonds, we'd all expect rates to rise at some point, but I think we could have been saying that for the last couple of years now. We just don't know exactly when they will, and even if they raise rates in September or at some point later in the year or next year, it doesn't necessarily mean that they're going to continue raising for every meeting thereafter. It could be a very slow and gradual process, or it could be quicker. But I think our view here is that you still want to hold some fixed income exposure as that volatility dampener. So holding some of those bonds to move differently than stocks if we do see stocks have a down market. But you just want to be careful about the types of bonds that you're holding. So you'd want to hold things that are shorter maturities so that they're affected less by interest rate risk than longer term bonds are, or things that are higher credit quality that are going to be a little bit on the more conservative side in terms of the credit rating. So those things aren't going to yield as much as, you know, things like the Puerto Rico bonds that we mentioned earlier. So they aren't going to produce as huge of coupons or dividends while you're holding them. But I think, you know, over the long term for a portfolio, we really view it in terms of wanting that volatility dampener, wanting that really safe thing that, you know, in a bad market for stocks is going to be a better performer than some of the riskier bonds out there.
Another question here. The S&P performed well, but my portfolio went down. Why? Should I change my allocation away from international stocks? Will the dollar ever weaken? Cool. You know, a lot of questions embedded in that question. So let me tackle it just from a high level. One, the result of a specific portfolio, I can't really say without seeing the portfolio. But I will say, you know, something that we saw certainly last year was the U.S. market did really well, and international markets didn't do as well. So a portfolio that was truly diversified, meaning that it held domestic and international companies, was relatively flat for the quarter now, for the year. Now, depending on your allocation, if you had more in international, you probably did worse than somebody that had more in domestic. The important thing to remember, though, is, you know, those asset classes tend to be volatile, meaning the U.S. can be the top performing country over some periods, and it can be the worst performing country over some periods. So as I was alluding to earlier before about performance, you don't want to make portfolio changes based on performance. Because what's going to happen is you're going to end up chasing the winners, meaning if you're running into or moving your portfolio into U.S. stocks now, you're going to be chasing last year's winner, and history shows us that that's not a good strategy. You actually will hurt your performance. So, and what we saw at the beginning of this year is that those international equities that didn't do so well actually tended to, you know, start off the year very strongly. So our suggestion is always diversify. We don't know what the dollar is going to do. We don't know what countries are going to perform well, which ones are not. Most often it's countries that we would never expect that end up performing very well over periods. The key is to diversify, be truly diversified. There are some, I would say, side effects to that a lot of people overlook. That, you know, when you are truly diversified, meaning you're holding companies all around the world, you're going to hold the winners, but you're also going to hold the losers. And behaviorally, we hate holding those losers. Nobody likes that. We always want to hold the winners, but there's no way of knowing beforehand which ones are going to be the winners and which ones are going to be the losers. And the data and research shows us that a portfolio that holds winners and losers over the long term does better than other strategies of, you know, trying to dodge, you know, move in and out of the market, trying to forecast which ones will do better. Because at the end of the day, imagine being in retirement and putting all your portfolio in that one company or that one asset class that happens to be the loser. That could absolutely devastate and change the outcome of your retirement. So, you know, going back to the slide that Matt showed where it had the portfolio that was diversified, that was always in the middle of those boxes, those asset class charts, by being fully diversified, you're always ensuring that, yes, you're never going to be the top performer, but you're not going to be the bottom performer. And that's very important in protecting the outcome that you're trying to achieve with your investments. Well, with that, that's all the time that we've got today. I apologize to anyone that submitted questions that we weren't able to get to. Please feel free to contact us directly. If you have any questions, you can contact Loring Ward or reach out to your advisor as well. With that, I want to thank everyone that joined us. I want to thank you, Matt, for your comments. And on behalf of Loring Ward and our presenters here, thank you and have a great rest of your day.